Hey everyone, welcome to this explainer. Today, we're diving into the absolute magic of how SAP S/4HANA handles cross-company transactions. If you've ever wondered how modern financial systems juggle complex purchasing and payments across multiple corporate entities without drowning accountants in a sea of manual data entry, you are in exactly the right place.
Here's our roadmap for today. We'll quickly hit the multi-company transaction problem, the one document rule, how cross-company clearing actually works, that tricky catch with taxes, setting up clearing accounts, and finally, the ultimate audit trail. Let's get right to it. Starting off with Section 1, the multi-company transaction problem. Look, in today's corporate world, companies are constantly sharing resources across borders and divisions. You've got central procurement, right, where one entity buys stuff, office supplies, raw materials, for everyone else just to get those bulk discounts. Or maybe central payment, where a single company code pays all the invoices for its sister companies to make treasury operations a breeze. So picture this. A vendor delivers a batch of goods to Company 1000 and a totally separate batch to Company 2000. Different goods, different locations. But just to keep the admin side simple, that vendor sends one single consolidated invoice for the whole shebang to Company 1000. Super common, right? Well, that brings us to Section 2, the one document rule. Here's the problem. That perfectly normal business scenario hits a massive brick wall in SAP. The rule is unbreakable. One document is assigned to exactly one company code, period. You literally cannot have a single financial document straddling two separate legal entities. Historically, this is exactly the kind of bottleneck that gives finance teams a massive headache. So how do we fix it? That's Section 3, how cross-company clearing works. This is where SAP's automation steps in, and honestly, it's brilliant. Instead of forcing you to manually enter endless duplicate documents, the system takes that single consolidated invoice and automatically splits it. It generates separate, distinct documents for each company code, which perfectly satisfies that strict one-document rule. And here's the real secret sauce. It automatically posts those line items to specific clearing accounts to balance the debits and credits for both ledgers instantly. No manual intercompany balancing required. But wait, there is a wrinkle. Section 4, the catch with taxes. You're probably wondering, if a single invoice gets split automatically across two companies, who gets stuck with the tax bill? Where do those tax lines actually go when the document splits? Well, SAP takes the easy route here. It always posts the calculated tax to the company code of the very first item entered. So if Company 1000 got the invoice, their item absolutely has to be entered on line 1 so they hold that tax posting. This works perfectly if the transaction isn't tax relevant, or if your companies happen to form a single taxable entity. But what if they don't? In countries like Japan or Denmark, tax regulations strictly require you to distribute that tax based exactly on where the expenses hit. You can't just dump it all on Company 1000. In those cases, you have to use a specific report, RFBus 10, to manually distribute the taxes across the company codes based on their actual expense amounts. All right, Section 5, setting up clearing accounts. For SAP to pull off this automated clearing magic, it obviously needs to know exactly where to put the money. Every single company code needs a designated clearing account, and SAP gives you options. You can use general ledger accounts, customer accounts, or vendor accounts. Just make sure you also assign the right posting keys so the system instantly recognizes the account type and knows exactly how to post the debits and credits. But here's the kicker, and this trips up a lot of implementations. You can't just make one giant intercompany bucket and call it a day. You actually have to explicitly assign these clearing accounts for every single possible bilateral combination of companies. Let's do the math on that. If you have just 3 company codes transacting with each other, you need 6 distinct clearing accounts configured: Company A to B, B to A to C, and so on. The automation is incredibly powerful, absolutely, but it totally relies on this meticulously mapped point-to-point master data to work. Okay, bringing it home with Section 6, the ultimate audit trail. With documents flying across different ledgers, auditors need a way to track it all. So SAP generates a cross-company code document number. It's a unique link that combines 3 things: the first document number, the first company code, and the fiscal year. This identifier is permanently stamped into the header of every related document, chaining the whole transaction together forever. Here's a quick pro tip for you. If you ever need to audit this, don't go hunting through individual company ledgers manually. Just run report RFVVOR00. The system grabs that cross-company document number and pulls up the entire integrated transaction on one screen for you. And hey, mistakes happen. But because these documents are intricately tied together via those clearing accounts, you can't just reverse one piece of the puzzle. If you did, your ledgers would instantly be out of balance. You have to use the specific cross-company reversal function to safely back out the entire linked transaction all at once. So, we've seen how SAP bridges the gap between complex multi-entity business realities and strict single-entity accounting rules through this automated clearing. It's a total game changer. But I'll leave you with this question to think about for your own organization. If SAP can automatically balance the books across borders and companies in seconds, is your financial master data actually clean enough to let it?